Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called Stochastic Pop Momentum. This one is built around the Stochastic Oscillator, but it uses it in a way that turns the usual textbook reading completely on its head. Instead of fading a high reading, it rides it. Over the next few minutes, we'll unpack the idea behind it, walk through the exact entry and exit rules, read the actual code together, and then follow an illustrated chart candle by candle. This is educational content only, so let's get into it. Let's start with the big picture. Stochastic Pop Momentum is a momentum ignition strategy inspired by Jake Bernstein's concept known as the stochastic pop and drop. Now, most traders learn that when the stochastic oscillator climbs above 80, the market is overbought and due to fall, and when it sinks below 20, it's oversold and due to bounce. Bernstein observed that at the exact moment of the crossing, the opposite is often true. When the fast stochastic line decisively pops above the upper level, that isn't necessarily exhaustion. It can be the signature of a fresh wave of directional demand, and price frequently keeps running in that direction. So this strategy does something contrarian to the contrarians. Instead of fading the high reading, it rides the pop. And it mirrors that logic on the downside, selling when the oscillator drops beneath the lower level. The reasoning is that an elevated reading is only bearish inside a range. Inside a genuine trend, a thrust that shoves the fast line through the upper level is a leadership and acceleration event, while the crowd that keeps selling every so-called overbought print supplies liquidity that the trend can feed on. To separate the good pops from the bad ones, the EA adds a trend filter built from an exponential moving average. It only takes upward pops when price is above a rising baseline, and only takes downward drops when price is below a falling baseline. That single filter is designed to remove the range-bound false signals, which is exactly where the classic fade actually tends to win, and keep only the continuation moves. In terms of who this is designed for, it's an educational example aimed at traders who want to study momentum continuation logic and disciplined risk control. It's engineered around a small, bounded risk per trade, with a structural stop, a reward-based target, a break-even lock, and an early exit when momentum fades. It runs on a single time frame and is written to work flexibly across foreign exchange majors, metals, and other symbols. Remember, trading always involves risk, and losses are a normal part of any approach. Let's walk through the mechanics. On every closed bar, the EA rebuilds four things from raw price data. First, the stochastic. It measures where the close sits inside the recent high-to-low range to get a raw %K, smooths that with a slowing average to form the fast line, and then averages that again to form the %D signal line. Second, it computes a trend exponential moving average on the close. Third, it computes an average true range as a simple mean of true range, used purely for sizing the stop. And fourth, it tracks the recent swing high and swing low. Now the long setup. For conditions must line up together. The fast line must freshly cross above the upper level, meaning it was at or below the level on the prior bar and above it now. The fast line must be leading the signal line, so %K sits above %D, confirming upward momentum. Price must be above a rising trend EMA, so the pop agrees with the trend rather than fighting it. And the igniting bar itself must close bullish. When all four align, the EA signals a buy at the ask. The short setup is the exact mirror. The fast line freshly drops below the lower level, %K sits below %D, price is below a falling EMA, and the ignition bar closes bearish. That's a sell at the bid. Risk control is where a lot of the design effort sits. The stop is placed just beyond the recent swing extreme, then pushed a little further by a fraction of ATR for breathing room. If that stop distance would exceed the maximum allowed multiple of ATR, the setup is simply rejected, which keeps per trade risk bounded and comparable across markets. The take profit is set at a reward ratio, defaulting to 1.8 times that stop distance. Two more protections manage the trade after entry. A break-even lock pulls the stop up to the entry price once the position has run a set fraction of its risk in favor, so a winner can't easily turn back into a loser. And a momentum fade exit closes the trade early if the stochastic lines cross back against the position, cutting a stalled move before it retraces. Only one position runs at a time, so exposure is never stacked. Let's read the code as it appears in MetaEditor. At the top are the inputs. K period, slowing, and D period define the stochastic. Pop level is the upper level the fast line must pop through, defaulting to 80, and the lower level is simply 100 minus that. Trend period sets the EMA filter. Then come the risk controls, the ATR period, the stop look back, the ATR stop buffer, a maximum risk cap, a reward ratio of 1.8, and a break-even fraction. Now the long block. It fires only when 4 flags are all true together. Pop-up means the fast line freshly crossed above the level. K greater than D confirms upward momentum. Trend up confirms price is above a rising EMA. And the closed candle is bullish, it's close above its open. When all 4 hold, the entry is taken at the ask, the stop is placed below the swing low minus a buffer of ATR, and the risk is the distance between them. If that risk passes the maximum ATR check, the take profit is set at the reward ratio times the risk, and the buy order goes in. The short block below it is a clean mirror. Drop DN means a fresh drop below the lower level. K sits below D. Trend down confirms price under a falling EMA, and the candle closed bearish. The entry is the bid. The stop sits above the swing high plus the ATR buffer, and the target is the reward ratio times that stop distance. Same discipline structure, opposite direction. Let's bring it to life on this illustration. Up top, we have the price candles with the blue trend EMA weaving through them. And in the panel below sits the stochastic, with the gold fast line, the blue signal line, the upper pop level at 80, and the lower drop level at 20. Watch how the two work together. On the far left, price is grinding gently higher. The first 3 candles each close a little above the one before, and crucially, they're printing above the blue EMA, which is itself tilting upward. That's the trend backdrop the strategy insists on. Meanwhile, down in the panel, the gold fast line is climbing steadily from the mid-50s toward the upper level. Now look at the 4th candle. It's a strong bullish bar that closes well above its open. And at that same moment, the gold line pushes decisively across the pop level at 80, having been below it the bar before. That's the fresh pop. And notice the fast line is sitting above the blue signal line, confirming upward momentum. Price is above a rising EMA, and the candle closed bullish. Every condition is satisfied, so the buy entry marker prints right here. Rather than reading that high stochastic as a warning to sell, the strategy treats it as ignition and rides it. Follow what happens next. The 2 candles after entry continue climbing, each one extending the move, and the fast line pushes deep into the pop zone toward 90. As price advances, the break-even logic would already be sliding the stop up toward the entry, so the trade is protected. By the 6th candle, price reaches the take-profit target, which was set at the reward ratio of 1.8 times the original stop distance measured below the swing low. The long is booked, and you can see the fast line beginning to roll over as momentum cools. Now the market changes character. Price stalls, then turns down, and the candles start closing back below the blue EMA. The trend baseline itself begins to slope lower. This is the mirror image setting up. Down in the panel, the gold fast line is falling fast, sliding out of the upper zone and heading toward the lower level. Watch the 10th candle, a firm bearish bar that closes below its open. At that moment, the gold line drops cleanly below the drop level at 20, having been above it the bar before. That's the fresh drop. The fast line is now below the signal line, confirming downward momentum. Price is beneath a falling EMA, and the candle closed bearish. The sell entry marker prints. Again, the strategy doesn't read that low stochastic as oversold and due to bounce. It reads it as downside ignition and joins the move. From there, price keeps sliding lower over the next candles, and the stop above the swing high protects the position while the break-even lock engages. By the 12th candle, price reaches the downside take profit, once more placed at the reward ratio times the stop distance. The short is booked. And notice, had that fast line instead curled back up and crossed above the signal line partway through, the momentum fade exit would have closed the trade early rather than waiting for the stop. That's the full cycle. A pop ridden higher and a drop ridden lower, each gated by the trend and wrapped in bounded structural risk. So that's stochastic pop momentum. We saw how it flips the usual stochastic reading on its head, riding a fresh pop above the upper level and a fresh drop below the lower level, but only when the move agrees with the trend EMA. We covered the entry conditions, the mirror short logic, the structural ATR stop, the reward-based target, the break-even lock, and the momentum fade exit. Remember, everything here is for educational purposes only and is not financial advice or a recommendation to trade. Every approach carries risk, and losses are a normal part of trading. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling me which strategy to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.